Lawyers are integral to ensure that the judicial system in the country runs smoothly. But the sheer volume of work that they handle sometimes leads to limited amount of time and attention being spent on personal finances. With an aim to guide lawyers on putting their finances in order, L&T Mutual Fund presents Investment Ki Paathshala, partnered by ET Now, where we invite 4 lawyers into our studio and have them interact with our experts. Hello and welcome to this special show called L&T Mutual Fund presents Investment Ki Paathshala, partnered by ET Now. It's a very special show where we're talking to people about how they can invest their money in a better way so that they can get optimum returns. The idea is very simple. We've all learned how to earn money, but very few of us have learned how to manage that money and how to make that money work for us. So on this very special show, we have 4 guests with us who will be talking to us and asking our experts about their personal finance queries and getting their doubts cleared. First up, let me introduce our 2 experts to you. We have Kripa Iyer. Kripa is the Zonal Head West and Central India at Sales at L&T Mutual Fund. Hi Kripa, thanks for coming on board. Hi. We also have Dhruv Mehta. He's a financial consultant with decades of experience. Thank you, Dhruv, so much for coming.
Thank you.
On my right, we have 4 talented lawyers. That's right, they're here. And well, of course, they're experts in their profession, but today we're going to be talking to them about personal finance. So first up, Sarosh, tell us a little bit about yourself and what's your question for our experts?
I'm Sarosh Damania. I'm an advocate practicing in civil litigation and aviation law. I majorly practice in the Bombay High Court. My question for the expert is, we as lawyers do not have a fixed income. We have fluctuating income. Sometimes we earn a lot of money, sometimes there's little less money. So my question was that once you have big lump sum money at a given point of time, what is the best option to invest?
So one has to think from the beginning, you need to have a plan that over the next 3-4 years, whenever I will get money, how am I going to invest? So basically have a plan in mind, because investments which are made without plan generally end up, giving you poor results. And the most important thing in that plan is to decide is that how much of the money is that I will be able to put away for a long period of time. So broadly, if you have to look into investments and classify, you would have 3 asset classes, I would say. One is debt, one is equity, and one is real estate. Now, real estate is a very large ticket size. So unless you accumulate a large amount of money, whenever you will get a lump sum, you will not be able to invest in a real estate. So you will have to build up a corpus so that there is an adequate corpus and you decide to invest in real estate. So keeping real estate aside, when you get some lump sum money, what you need to decide is that whenever you will get this money, and is that something which you can put away for 5 or 10 years? If that money is something which you don't foresee that you can put away for 5 to 10 years, you think you might have some requirement for any expenditure, for travel or for any purpose, then that is the money which you would have to perforce put into debt. Correct? So that is one approach, that if this money we are not sure, because typically you get a lump sum and many times you don't know, okay, what will be my expense. So put it away into fixed income, into debt. It could be a simple fixed deposit. As you keep accumulating this, the second option would be that over say 2 or 3 times in a year or over 2-3 years, when you have been putting this money away, you need to every time reevaluate, okay, how much of my money has grown or accumulated. And you will decide some threshold amount, okay, once I have some kitty, X amount, 10 lakhs, 20 lakhs, 30 lakhs, then I can take some extra risk.
Right.
So one is to have some sort of a contingent first minimum. Second is to look at the time horizon. So as and when you get lump sum, first is to see that you have some sort of a contingent or something, something goes wrong, so which is very safe into fixed income. So I would say broadly, you have to look at fixed income is something which is providing you shade, and equity is something which will give you growth. But equity has a lot of volatility. So in the beginning, it's always better to build up some sort of a buffer so that you can take a risk, and always evaluate. I mean, it's very simple, I think, that the money which you get, 100 rupees, I mean, you have to think, this is what you really need to think. Can I put this money away for 10 years? If you're very clear, I can put it away for 10 years, then only you think about putting it in equities. Otherwise, you put into debt.
All right, let's move on. Shefal, tell us a little bit about yourself and your question for our experts.
My name is Shefal Charawala. I'm an advocate. I graduated 2 years ago from KC College of Law. I've been practicing at Saroj Charawala and Associates since the last 5 years. 3 years as a paralegal and 2 years as an associate. At Saroj Charawala and Associates, our main practice is real estate law, with our forte being conveyancing, testamentary succession, family arrangements, and even redevelopment matters. Now, my question for the experts is, since we have variable income every month, what I wanted to do was generate a fixed amount of passive income every month. So what are the instruments that I should invest in which generate passive income?
Firstly, I would want to also set one context right, that because the incomes are always fluctuating, one aspect which is always constant in our lives is expenses. So the first parameter is to define expenses which are necessity and expenses which are luxury. Many a times when we have something coming in flux, we get carried away saying let's binge in terms of using our credit cards, and we postpone the payment of credit card and end up buying then. So it is important to figure out what expenses are necessary, what's the kind of flow that you can expect in a year. You may say it's not too hard-coded in terms of defining the flow, but if at all you can set a trend of next 6 months, next 7 months looks good. So then once you fit the expense matrix, so this is going to be my necessity expenses, can I kind of curtail my spending for the next 6 months and kind of build a savings plan, a contingency plan. The contingency plan could be to take care of your expenses for the next 6 months to 12 months, and the savings could be that something which you would want to invest. Expenses, once you define, you would have a clarity that whether I'm going overboard or whether I am kind of disciplining myself in terms of spending, whether I'm overspending or not. Then once the savings is defined, say the first month you have say a lakh of rupee coming in, the second month is 5 lakhs, at least you would know that my expense is 50,000. The 50,000 has gone into saving. The next month you would define saying maybe I can up my expenditure 25-30% and the rest can go into savings. That kind of eases your annual plan, saying okay, there could be 1 or 2 big months in a year that takes care of my annual savings. Once that is defined, you can then figure out, when you're talking about passive income, the passive incomes takes time. Okay, so you have concepts like systematic withdrawal plan into mutual funds, which is a unique concept. After the budget, of course, the dividend plans are not very investor friendly. But when you're talking about systematic withdrawal plan and you're talking about getting an X percentage of money which comes into as a passive income, then you have to define your initial period of investments for say 2 to 3 years. So you invest into an equity fund, you cannot suddenly start doing the systematic investment withdrawal plan the next month. You have to commit your investments for 2 to 3 years before you start doing the withdrawal. But you can bucket it basis your short-term, long-term goals. You say that, okay, I would want to plan a foreign trip in next 2 years and I want to go to a particular destination. You can look at a debt plan. If you have a long-term plan of buying a house, or you have a long-term big investments outflow planned out, say 5 to 10 years, then you can surely look into equity. And for that you can commit and bucket your investments between debt, equity, basis short-term, long-term needs.
Superb. So let's move on. Roshni, tell us a little bit about yourself and your question.
So I'm Advocate Roshni Nachwani, and I'm an intellectual property attorney and the founder for Intelexis Legal Solutions. We basically help clients protect their trademarks, copyright and patents. So my question for the experts is, what are their thoughts on fixed deposit as a consistent interest income for lawyers like us who generally don't have consistent income inflows?
So yeah, definitely fixed deposits are perceived to be very safe, and they are safe in the sense that if you put in a public sector or even some of the large private sector banks, the likelihood of that bank defaulting is very less, correct? But if you look upon the money that you invest, I mean the longer your time period, if you take a period of 10, 20, 30 years, in a fixed deposit, what will happen is that you will keep getting a fixed rate of return. Correct. So what happens is that you are bound to that fixed rate, and generally that rate does not cover inflation. The rate that you will get from a bank is, because the way interest rates are set, they are always in line with inflation or a little above inflation. So your actual real wealth does not increase. So fixed deposits are safe in the short run, but actually you lose money in the long run in terms of your ability to what you can buy with. Supposing you put 100 rupees in a fixed deposit and what you can buy today with that 100 rupees versus, after 20 years what you will buy with that 100 rupees. So that's what you need to keep in mind. It's very safe, you'll get a predictable return. But the longer the time period means if you are looking at investing for 30 years, you should be willing to let go little of the predictability for a higher growth.
Let's move on. So Vinny, tell us a little bit about yourself and your question for our experts.
I am Advocate Vinit Jain, practicing on the financial crime side, which involves cases dealing into financial bank frauds and money laundering cases and etc. As we lawyers, we have fluctuating incomes. So I wanted to ask the expert what would be the best possible sector to invest in the long term.
When you're talking about the form of investments from here on or probably 10-15 years down the line, when you're planning long term, you need to get into a product which is regulated. You need to get into a product which is liquid. You need to get into a product which is least complex. Something which you are able to understand and relate to, saying, okay, ye samajh aa raha hai, I would want to get into this. So I think mutual fund as a source of option for investments, they have a varied gamut of options that kind of take into consideration your form of thought process of investments, whether it's short term or long term. Do we get into real estate to plan our retiral? I think because of the liquid nature and because of the unpredictability whether that particular investment will fetch you returns over a period of time, and whether the process is regulated in terms of saying whether this product is inflation adjusted, these parameters yet not set, early days. So you need to firstly focus that whichever product I get into is taking care of my inflation and cost of living. Today it may look very great that okay, इस पे 6% 7% safe product hai and I have a peace of mind. But the same product 10 years down the line, whether you may feel the definition of wealth creation done having arrived, may not kind of take care of your expenses then. So the dynamics, the best thing is for today's generation and age, and people who have money or people who are planning to invest, there are various form of investments which are available, which are aligned to today's thought process as well as taking care of your future cost of living. And cost of living is going to only increase. And what has happened is we may have inflation as one particular percentage parameter, but now it's kind of got customized. You take your medical bills, you take education, you take the travel. No 2 years are the same. Right, so we may talk about insurance. It's very important to have term and health cover, but at the same time you need to have a backup fund to take care of unforeseen expenses which may go beyond the insurance cover for you. So as much as investment getting not much of weightage or leeway or priority, I think in today's day and age it becomes important to kind of sit through it and prioritize that aspect first.
Dhruv, one question that I had is the thought of having a financial advisor. Because I think it was mentioned earlier in the discussion also, how important is it to have a financial advisor, and importantly, how do you choose a financial advisor?
I think most people cannot do it on their own. So there is always that space, even like whatever profession, if you are a lawyer or even if you are a financially successful, say, CFO of a multinational or a large company. So what happens is that if you want to invest money, one is you need to have a plan. Second is, as we have discussed, and second is it needs to be implemented and monitored. Right. But people who are not doing investments day in and day out, they are busy with so many other things. So therefore there is a need for you to rely on somebody. And I think we have all lawyers here, they are professionals. I mean, typically today if I have a legal problem, I will definitely go to one of them, seek their advice and go by what they say. Because I mean, that is not something which I am passionate about, correct, on a day-to-day basis. So therefore I think every profession, whether it is an accountancy, whether it is A profession is required because that profession requires some sort of education and some sort of expertise. And I would say simple thing like even driving a car. One can drive a car on its own, or one can have somebody else drive the car. Why do you have somebody else drive the car? Because you don't want to drive, he drives. At that time you are free to do something else, talk on the phone, finish something. So the same way I think a financial advisor helps you that. I think he gives you peace of mind and he saves your time in doing the things that you might not want to do. But say somebody who loves doing, reading about a company, about a stock, he can invest directly. But today you have mutual funds as a vehicle. So you again entrust to a professional person to buy the stocks or the bonds. Same way you take an advisor so that the advisor helps you in doing the planning, keeping a track that your plans are being met or not. So, that's what, in fact, I'm part of an association of advisors, and we just have a tagline, Sarthi Zaruri hai. So like even Arjun needed, Krishna as a Sarthi. So he was an expert, but he still needed somebody when he was confused to guide him to the right path.
Kripa, I had one other question for you. So, since, all the four lawyers have spoken about the fact that the income is kind of cyclical. So, there'll be some months where there's a lot of money coming in, some months where it's just about decent. In this case, where they have this lump sum amount and they might want to invest it in mutual funds. Now, the SIP, which is the systematic investment plan we've heard about, we've discussed, a lot of people know about this. But how can they use the STP, the systematic transfer plan, for in this case? Could you shed some more light on that?
So basically, once you have defined the goals, or once you have kind of figured out your expenses, monthly expenses, and what is the direction to the flows or the lump sum money that you will get in a year, and you have decided on a particular amount that you have to invest. So when you've defined it's long term, 4 or 5 years, I would want to commit a particular amount of money. You may not want to, so equity is one great asset classes where you had, one gentleman had highlighted that I look into stocks also. So an asset allocation can have direct stocks as well as mutual funds. When you come to mutual funds and you want to get into equity, you are still unplanned saying, okay, I have 5 lakh of rupees, but I'm not too sure I can fully commit this today. As of now, it looks great. I don't have any other commitments coming up. So you get into probably the debt fund, the safer plans where there's least volatility. You're talking about certain plans which are a 1 day maturity or a 1 month maturity. You get into those kind of debt plans and then trigger a systematic transfer plan into equity. The commitments could be if you are very sure that the money is not required. The commitment of switching that money into equity could be as less as 3 months to as long as 3 years. So and the beauty of that plan is, if at all suddenly you feel the need, okay, I have something coming up and I may not be able to commit, you can also set up an advice with your financial advisors to stop the STPs into the equity plans. Basically, that helps you stagger the amount, lessening your risk and probably averaging out your investments for the volatility that you have in the equity schemes. And also kind of at the back of the mind, you don't have this fear that, okay, I've committed entire amount and it's got stuck. Right. It's highly liquid. So it builds the efficacy in terms of your decision making, whether I would want to stay or commit these funds for long term, short term.
So we're just about running out of time, but if there's any last one question, if anybody has, otherwise I can throw in. Yeah. Sure.
Now, of course, we've discussed a lot about what to invest. Is equity safer, fixed? Now, of course, now we have got the basic gist of it that equity is a much better return what you might get. Now, I had one question in this is, now one is mutual fund and another thing is directly investing in a company. Correct. So, doesn't directly investing in a company give you a better return than a mutual fund? Of course, the risk aspect will be there. But as an expert, what do you recommend that you should go for the safer option? If somebody looking for a higher return, you should directly go into the market and directly invest in companies.
So the question is that if you invest direct and if you invest in one company, there is a possibility that you will make much more return, because typically when you give money to a mutual fund, it is going to be diversified across 15, 20, 40 stocks. So when you invest in one company, and if you think that you're that good, that you were able to identify, say, Bajaj Finance, but there is also a possibility that you might have bought in DLF or you might have bought Yes Bank. So if you have bought one share of Bajaj Finance and one share of, say, DLF, your average becomes, And like that, if you're going to have a portfolio of 10, 15 stocks, because it is not advisable to have in only 1, 2, 3 stocks unless you know that much about the business. So basically your risk is when you don't know. The business that you are investing in, what you don't know is the risk, correct? What can happen. So if you are very sure you know the business, and today I think any business, any business is so complicated in terms of what are the external factors. For example, say coronavirus, how it is going to impact a business unless you have in-depth knowledge that okay, supply chain is going to get impacted. No, this is not, it has nothing to do, maybe it's an IT business and nothing is getting affected. So like that, if you think that you are capable, competent, and you're going to spend time, because what a fund manager does is 24/7, he is monitoring this. He's supported by a team of, 7, 8 analysts. He's supported by the whole broking community which gives him information. So I think it is very difficult for an individual to compete against that. I'm not saying it is impossible. If you have the passion and you say, I'm going to do 24/7 only equity research, you will be able to identify a winner and a stock winner.
Also to, I think, add one more point. See, as an investor, there is always going to be noise that you get carried away with the recent news and trends, buy this stock or this looks good. First, you sit with a financial advisor in terms of defining, okay, this is going to be my cash flow, X expenses and other commitments taken care of. You would also you can gauge how much can I invest as into stocks and mutual funds. Hypothetically, 6 months planning you just have 1 lakh. There you cut the noise saying, okay, my choice of funds are now restricted to only either doing an STP or SIP or mutual funds. Because 1 lakh, what are you going to do? Whether you want to do real estate or gold or stock. So once that planning is taken care of and this is the cash flow which I want to invest, is where you can define whether I have to get into the stocks, mutual funds, because the noise will always be there. And then, the level of stress also can cut down, saying, okay, I have lakh of rupees, as sir said, coronavirus ka tension nahi hai because 1 lakh hi invest karna hai.
Superb. Well, we're just about out of time, but thank you so much, Sarosh, Shefal, Roshni and Vineet for coming into the studio, and thank you, Dhruv and Kripa, for coming and guiding them. Thank you so much for watching. You've been watching L&T Mutual Fund presents Investment Ki Paathshala in association with ET Now. We hope we've been able to guide you as well so that you can better manage your finances and secure a financially safer future for yourself. Thank you so much for watching.
Mutual fund is a wonderful vehicle especially for people who are short of time, and I think lawyers are very short of time. They have very busy schedules. So I think they need to look at mutual fund as a vehicle, and I think if they are to get in touch with a financial advisor who will advise them to plan their finances, I think that's the message I would give them to achieve their financial goals.
I think the lawyers were pretty interested in terms of knowing all about investments. It's very important that you show your interest and keenness that you want to do financial planning and set a discipline in terms of savings. And I think the takeaway is that they have age by their side and they can plan well. They can start early. That's the feature which we actually tell people who want to kind of build wealth over a long period of time. And I think they are pretty serious in terms of taking the cues forward. It was a very positive, receptive audience, and I suppose probably they would be able to plan in consultation with the financial advisor.
Now we have a better perspective, better mind thought, how a planned financial investment used to be there. Of course, I used to do investment but very unplanned. So now after this, it might get me a right track of planning the investment.
I learned a lot of opinions and perspectives and an interesting insight into how to invest my finances in a better manner to get better returns.
Normally what I do is, as soon as I get my lump sum, I just have a certain investment in mind. I ask one of my friends, okay, what's looking good right now? And just dive straight into it. But what the expert said was, that's not the way to go about it. You need to think about what your goal is with that money, when you're going to need that money, and then look at what instruments to invest in. So that was my key takeaway from today's
Time frame when you want your returns or the amount of money which you want at which stage of your life, and accordingly start your investments from today, because the more later you start, the risk proportion will be higher which you need to take to get the returns which you want.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.